Chapter 13 is really on financial analysis. There's a few objectives to it. Today, I'm just going to introduce you to a few concepts. And next week, we're going to basically focus in on financial analysis. So this is really what the meat and potatoes is of this chapter. Will be done next week. Just wanted to introduce a few things this week, though, from Learning Objective 1. So first, the concept is called sustainable income. So something that's sustainable can last for a long time. And when we're talking about income, in this case, we're talking about profits. And so when we're looking at sustainable income, companies are often looking at a level of profitability that can run into their future, right, indefinitely. Certain things, however, get in the way of that track record. We call those things unusual items. Sometimes unusual items are not very unusual. But they're unusual in the sense that they kind of give you a weird trajectory. They have a weird impact on the profitability of the company over time. So what can be an unusual item that's very common? The most common unusual item is something called a discontinued operation. That's when a company either decides to close down a particular, it could be a product line, or it could sell off a part of their company to another company, so it's discontinued it. But anyway, when they're discontinuing a particular operation, it's going to impact their profitability, if not temporarily, a little bit more than that. Sometimes getting rid of a particular product line or a part of the operation is a very good thing. It actually enhances your profitability over the long run because this particular product line or this division was weighing you down, from greater profitability. It really sort of depends. And so discontinued operations is one of those things you have to know a little bit more about. And another issue that we talked about briefly way back in chapter 5, I believe, comprehensive income, it comes up again here as something that's an unusual item. What's unusual about each of these? They affect profitability, they show up on the income statement, and it makes the company look either more or less profitable than it really is. And so that's why they're considered unusual. Okay. So here is a company called Cruise Company. They have an income statement. It's a statement of comprehensive income. So it's not just an income statement. It includes comprehensive income as well. And they show here, sales of 900,000, a gross profit of 250. Their profit from operations is 150. Then they have their profit before tax, their tax, and their profit from continuing operations, the profit from what's continuing in their business, what they're continually going to make and sell, etc. However, they've noted that there is a discontinued operation. Now, in this case, the discontinued operation might be a product line or a part of their business that they've sold off or closed down. My guess here is it might have been sold off because they gained $30,000 from this discontinued operation. So this $30,000 is going to make the company look a lot more profitable. But how many times can you sell off part of your operation? Once, right? If this operation was making potato chips and you decided to sell it to another company, you're no longer making potato chips. You just sold it, gone. So this is an unusual item because it doesn't happen all the time. It's irregular. And even worse than that, it made you look more profitable, right? It made it look like you made $30,000 more than you did. Because now your profit has ballooned to 176,000 from 146,000 because of that. Okay, that's unusual. Another thing that's reported here is there are certain gains that are reported as what we call other comprehensive income. Usually this falls to, as you'll see in a minute, gains on investments that the company might have, and they have to report those on their income tax, on their income statement. Okay. So here, this other comprehensive income also boosted their total profitability by another 10,000. These things don't happen. I mean, these don't happen all the time. These are not sustainable because at one year you might see that you've gained money on investments, another year you've seen that you've lost money on investments. And so this is an unusual item like discontinued operations is because it's very irregular, very irregular. In this case, your profit now with comprehensive income included is 186,000, much, much greater. So your company looks a lot more profitable than it is, right? Because of these unusual items that you had to report. So a couple of notes that your book makes. Discontinued operation simply means that the company has either sold off or closed a significant component of their business. So, for example, way back in 2008, 2009, when the collapse happened, financial collapse, General Motors had to make, and Ford had to make a lot of decisions as to what is worth keeping and what is worth closing. And they basically disposed of several product lines. General Motors doesn't make as many products as they used to, right? And so that became a discontinued operation because they stopped building certain things. In some cases, they might have sold off a component, but either way, it's a discontinued operation. When you dispose of a part of your business, either through selling it to another business or closing it, you have to report either a gain or a loss from that. Okay. This gain or a loss goes on your income statement. And so that's why it is an unusual item. It either will, if it's a gain, it's going to make you look more profitable than you are. If it's a loss that you report, it's going to make you look like you lost more or you weren't as profitable as you really are. So that's why it's important to know discontinued operations. And I didn't mean to kind of cross it out there, but I will discontinue with that right now. So here's an illustration of discontinued operations for a company in 2017 called Acro Energy. So they have a profit before income tax of 800,000. But during 2017, Acro discontinued and sold its unprofitable chemical division. So it's a whole division of their company they sold off. You can only do that once. They can only sell their chemical division once, right? It's not going to happen. That's what makes it unusual. It's not sustainable. The loss from that was $60,000. Oh, sorry, was $140,000. That's net of $60,000 in taxes. Okay, because it's a taxable event. The loss on the disposal of the chemical division, sorry, let me go back here. The loss in 2017 from the chemical operations was 140,000. Okay. That's the operation, the chemical operations. So that division was losing money. The loss from disposing it, from selling it off, was 70,000. So it's a good thing. Assuming a 30% tax on income. So here they want you to look at the statement of comprehensive income for this company. So here they had, let's go back to some of the data. Income before taxes of 800,000. Okay, and remember we have a 30% tax rate. So income before taxes is listed first at 800,000. Then we have 30% of that dedicated to an income tax expense. When we subtract that out, this is our profit from continuing operations. Now we have to recognize the losses that we took on the chemical division. So first, the loss from the operation of the chemical division cost the company $140,000. That's a one-time thing. And the loss from selling it off ended up being $70,000. So in total, between stopping the operation of the chemical division, when you close a division or you start, there's things to pay. And then you sell off that division to another company. In this case, they sold it on the cheap, so they took a loss. That's a $210,000 loss that they had to take this year. It's unusual because it only happened that year. So that affected their net income. Their net income is now $350,000, not $560,000. Look how much that unusual item shrunk the profitability of the company. When people read their financial statement, their income statement, they're going to say, oh, they only made $350,000 this year. Well, that's not the story, really. They actually made $560,000, but when they stopped and sold off their chemical division, they had to report a $210,000 loss on both the operation and the disposal. And that's why you only see $350,000 as their profit for the year. Okay. So that's an important distinction to look for. And again, it's supposed to be an unusual item is supposed to be a non-recurring item. In reality, as the story says, some companies have non-recurring items occurring quite a bit. They're not supposed to do that. But anyway. The other issue is comprehensive income. Now, comprehensive income is all changes to stockholders' equity except from stock itself, from their and distributions, which is their cash dividends. So what's left? What's left is basically certain gains and losses on what we call available for sale securities. Directly affects the owners. They don't get reported as net on their net as net income. Instead, they get reported as adjustments to stockholders' equity. So let's see what this means here. Okay. First things, why do they have to report the comprehensive income and report these gains and losses? Well, because GAAP requires companies to adjust their investments in stocks and bonds up and down to the market value of the stocks and bonds at the end of each accounting period. If the market value is higher, than it was in the last accounting period, they have to report it as a gain. If the market value is lower than the previous accounting period, they have to report it as a loss. It's technically on paper. Okay. It's not a real gain or a loss. It's sort of a paper loss, but still in accounting for a company that owns investments, you have to value your investments properly, right? And so if you're going to have investments, they need to be properly valued. How are they adjusted? Through stockholders' equity, basically. So here's an illustration. During 2017, Stassi Company purchased IBM stock for $10,000 as an investment. So this company has a stock investment for $10,000. At the end of 2017, the market value of the IBM stock is now $8,000. So they didn't sell the stock, they still own the stock. But there's a $2,000 difference in the stock price, right? Because the market value of the stock went down from 10 to 8, that $2,000 loss of value is being reported as other comprehensive income. So, this slide evaluates it a little bit further. So, part of it is, as they say here, how does the corporation classify the investment? If the investment is a trading security, or if it's an available for sale security. Most companies, when they have investments, would basically put them as available for sale securities. Okay. So that means that any unrealized gains or losses would have to be reflected in comprehensive income by taking it away from stockholders' equity. So here we go. So here's the $2,000 loss. In the first format, we can put it on the income statement after net income is determined. We can declare other comprehensive income and say that we have a paper-based loss, right? Our stock went down 2,000. So basically, we're going to show it as an unrealized loss and adjust comprehensive income by that. Okay. Again, they didn't sell it. It's just on paper. That's what the value is. This is the other comprehensive income. Sometimes, if you don't report it on the income statement, you can report it on the stockholders' equity part as an other comprehensive loss underneath stockholders' equity. Either way, it has to show up. Either you can put it on the income statement, which is most commonly done, or you can put it on the balance sheet as a other comprehensive loss. We're focused here on the income statement. So here what we have is an example of a comprehensive income statement. So it's basically an income statement all the way down to net income, and then they have that other comprehensive income issues stated, and then the difference is comprehensive income. Notice what happens after your profit from continuing operations is given. So this is pretty standard. You've seen this over and over again. First, they list the discontinued operation issue. Okay. So basically speaking, they had a loss from their operation of this division and a loss on the disposal. Oh, sorry, and a gain on the disposal. So they lost $60,000 from closing this division, minus a $18,000 tax break. They have to write off a $42,000 loss that year. However, when they sold that plastics division to another company, they sold it for $50,000. They have to put aside $15,000 for income tax. So they actually gained $35,000 from the sale. But when compared to closing the operation from the gain that they made on the sale, they ended up losing $7,000. So that means that their income needs to be adjusted by that discontinued operation. Again, this is only happening once. They're only selling that plastics division once. But see how in this case it lowered the total net income. Okay. Then take into consideration they have to report comprehensive income. In this case, they have an unrealized gain, okay, from for available for sale securities. It's a $15,000 gain. They'll put 30% aside as taxes. And here they need to report an additional $10,500, even though it's an unrealized gain. But look, it just boosted their overall comprehensive income. So when we're reading income statements, okay, just know that when companies have discontinued operations, it's an unusual item, and it is going to affect what looks like the net profit of the company is. So we have to sort of take this into consideration. Another thing we have to look at is this other comprehensive income because they have to adjust the market value. Well, the market value is just the market value. It's not a real gain or a real loss yet until they actually sell it, but they have to report it. They usually report it on the income statement. Okay. Other types of things that can get in the way or distort the profitability or sustainable income, sustainable profits, is sometimes companies do change their accounting principles. Okay. They have to have a very, very good reason to do that. Okay. So in other words, it has to be something that will convince everyone involved that this change is warranted. They can't go back and forth, but they can change accounting principles. So for example, a company might decide to go from FIFO to average cost. Again, if management can show that this is preferable and reasonable, it's allowed. It's allowed by GAAP. It's allowed by the IRS. It's allowed by the SEC. And thus they can change it. But those changes have to be reported retroactively. It's going to have an impact on the profitability of the company when you go back and need to adjust your income statements and so forth for this change in accounting principles. So it might really interfere with that. So this part of the chapter ends with something called the issue of quality of earnings. So what's a high quality of earnings? Basically, when the information that's presented on the income statement is full and transparent. It's not meant to confuse or mislead anybody who's reading the income statement or using it to make decisions, particularly investors or creditors. And it's something that needs to be strived for. Okay. However, as you have heard many times, there are accounting scandals that do happen. When corporations spend more time managing how their financial statements are going to look, how their profitability is going to look compared to how their business is really looking. And so some companies get in trouble by spending too much time, as this says, managing their profits rather than managing their business, because that interferes with the quality of earnings. Okay. Sometimes the quality of earnings is impacted by changing an accounting method, maybe from LIFO to FIFO. Sometimes we have to look at, something called a pro forma income statement. Pro forma income statements are forward-looking. This is what we think we're going to do in sales and costs and expenses this year, and this is what our profitability is expected to be after this quarter and after that quarter at the end of the year. Pro forma statements exclude anything that's unusual. And so, this can be ripe for abuse, and not always a good thing. Some companies don't do their accounting very well. What we call improper recognition is not recognizing revenue when it should be, not recognizing expenses when they should be, not reporting all their assets or liabilities appropriately. That's what improper recognition is about, those types of abuses. And again, it sadly, it happens. So I just wanted to give you an idea of these unusual items. There's going to be just a little bit on this for the analysis, but not a lot. Most of the work we're going to be doing is learning objective 2 and 3. But I just wanted to at least get this covered and sort of out of the way with a little bit here. It's not a lot of fanfare here. So here's an example. Do it exercise number 1. Shows it's a proposed income statement. So proposals are usually pro forma. Okay. You have Air Corporation. They're going to report income before tax, so profit before taxes of $400,000. They have an unrealized gain on available for sale security of $100,000. Their income tax is $120,000, not including any unusual items. They have a loss. Here we go. They have a loss from discontinued flour division. It's wilting. They had to dispose it. So there's a little bit of a loss there. Income tax rate we're looking at is 30%. So here we're looking at preparing a statement of comprehensive income, starting with the income before taxes, which is our $400,000 and going from there. So here we have our $400,000. We're taking away 30% as an income tax expense, leaving our profit from operations at $280,000. We have to recognize those discontinued operations from the flour division. Okay. So we had a loss from the flour division. Let me go back to that number. Oops, sorry, go back. It's a $50,000 loss, but when you take 30% out for taxes, the net is $35,000. The loss on disposing it was, I think the number was $90,000. 30% of that puts aside $27,000 for taxes. So another loss of $63,000. These two are both losses. So the total is $98,000. That's just from discontinued operations, which is an unusual item. And that affects the profitability of the company. The profit's only $182, right? So from $280 all the way to $182 because of the selling off of the flour division. And now we have to know that other comprehensive income, which we go back here, that $100,000 unrealized gain needs to be recognized. And so we have an unrealized gain. We put 30% aside for taxes. So this gain is going to add to our profit, and comprehensive income will be $252. So I am going to give you a little bit of work on that, not a lot, but just so you can. But I think what's really important to understand on that is what a discontinued operation is and how it affects the net income, the profit of the company. And understand that a lot of corporations do have stock and bonds and other companies as available for sale securities. And so as the market value goes up and down, they usually report it on the income statement as other comprehensive income or loss. And that also plays with the numbers. So when people are looking at the financial statement, are they really kind of getting the whole picture? You have to look through these things, right? Discontinued operations, again, should be pretty unusual because how often should they be happening? Not very often. That's why they're unusual. And the comprehensive income, I didn't really look at it really much before because it sort of takes away the story of the net income, the real profit of the company, because it adds this other layer of an unrealized gain. That has to be reported because GAAP says you should account for everything. Right. So, so a little bit on that, but most of your work this week is going to be on the Chapter 12 test.